the most surprising thing about 2021 is it's the largest year for funding since we've been keeping track of it, at $643 billion, I believe is the number. And if you look at that trend, it's almost double 2020. And if you go back a decade, it's like 6 times larger. So there's a lot of money flowing into various stages of startups. At a high level right now, everything is hot. There's been a large increase in the investment level. There's now more than 1,000 unicorns, and a unicorn is a company that has achieved a $1 billion valuation that's not yet public. And so that was something that was discovered in like 2013 by Eileen Lee at Cowboy Ventures, and there's now I think she found like 13 of them. There's now more than 1,000. And with that, the 2021, the count and the amount of money in IPOs, initial public offerings, is also at record levels, and that's putting money back into the ecosystem that's then used to fund new startups. We're going to talk a little bit about 2020 to 2021 being a period of withdrawal and return for founders, just because of COVID and kind of the changes that imposed. And when everything is hot, I think our advice is to be guided by your expertise and the customers that you want to serve, as a final thought. So we're not where we thought we were going to be in early 2020. In early 2020, the National Venture Capital Association said things are grim. We're facing a capital crunch, and already in the first 3 months of the year, 300 startups have laid off 30,000 employees. PitchBook, which is a well-respected set of analysts, said we're going to see Q1 of 2020 probably okay, but after that, we're going to see a decline in total venture transaction volumes. So things have turned out quite differently than we thought where we thought we would be 18 months ago. This is a little bit of a look back for history from what happened between, let's say, 1996 and 2001. That curve to me looked a little bit like the curve we just looked at for 2017 to 2021. And then there was a reversal. So hopefully that doesn't happen again. Although these numbers are 40 billion, the 2021 number is 15 times higher. So it's the idea of scale. Here's the IPO counts, and you can see that in the last 2 years, they've tripled between, the amount of money has tripled between 2019 and 2020, and doubled again almost between 2020 and 2021. So a lot of money is flowing in. These SPACs, or these special purpose acquisition vehicles, it's essentially an IPO for a player to be named later that then pulls another company public by acquisition. So
Sean, like, if you thinking about some of the data that you just showed, and if like history was to repeat itself for us founders here in the room, would the recommendation be raise now while it's hot, because it won't be there in the next year or two?
So the question is money is never free, right? And so the question is, at what terms, and what do you plan to use the money for? So if your business needs the funds, then you should definitely raise it now. But I think raising in anticipation of some future requirement can be a tricky proposition. We're living a little bit in unprecedented times. So it just, both with the pandemic and then with this level of investment and the other things that are going on. So it's a little hard to determine what it's going to look like. I guess I'm not answering your question very well, but the money is never really free, right? They're never really giving away money. So you can end up in a situation where you've signed up for something you can't deliver on. And that's got problems as well. So the other way that money flows in is through merger and acquisition. And here again, we see a substantial increase in deal volume in 2021. The yellow band are deals that were $5 billion or more. And so that's almost double the prior year. And the other two tiers are also up. So yeah, Ed Keyes makes a point. Taking funding starts the clock ticking for when you have to show a big return. And if you take money in the current environment, the expectation of a big exit is high. So you may definitely be signing up for something that you're going to have trouble delivering on. Here's a little bit on the unicorn deals. As you can see, that's been building steadily to where they're also way up in 2021. So why so many unicorns? So for investors, they're looking for a few big winners. So they're hoping that one or two winners essentially justifies their fund. There's another factor at work here that's potentially called a Minsky boom. Minsky is this economist that said if you look at the way that investment flows, when you see money flowing into a sector, it can make it look safer than it is. In a Minsky boom, as capital flows into a market, and we're seeing enormous capital flows coming in, then you see in the near term kind of higher returns, the perception of lower volatility, and what looks like better risk-adjusted performance, because as the money comes in, there's more investments. If you make a seed round, there's somebody to do the A, there's somebody to do the B. But at some point, the merry-go-round starts to run the other way, and you get something like 2001, where there's many fewer exits, the market appears unattractive, and there's down rounds or kind of involuntary exits of different sorts. So the question is, if and when that comes, given the amount of money flowing into venture. So a couple challenges with this unicorn model are that in the beginning, that might have been driven more by bragging rights, and you can trade deal terms for valuation. So at some level, what can happen is that the founder payout goes down dramatically if the promises, if the dreams don't come true. And from the investor point of view, they still just need a few big winners. I think I mentioned this already. You have to be careful. Money is never free, so you really only want to raise what you need, or what you, with perhaps some prudent cushion, but not. There's no point in raising twice what you need or 4 times what you need if you don't have a plan to spend it intelligently.